Hello and welcome. Thanks for being here. I'm Rhonda Schaffler. It has been quite a year for stocks. As you know, you might recall in March, the S&P dipped into bear market territory. Then we had October. And of course, through all this, investors are trying to navigate some really murky economic waters. And for those reasons, we are so pleased to have with us today Mona Mahajan of Edward Jones. She is Chief Investment Strategist there. Thanks, Mona. It is always a pleasure to speak with you.
Thank you so much, Rhonda. And as you said, it's been quite a year in markets. Glad to be here today.
Oh my goodness, we have so much to talk about in a little amount of time. And I want to encourage those of you who are joining us, feel free to put a question in a chat. We're going to try to get to as many as we can. And also take our poll, please. We're going to share those results shortly. All right, Mona, we're going to dive in because we had September. Then we had October, and we know that was one of the best months we've seen on Wall Street in decades. So your thoughts on, first of all, whether the worst is behind us in terms of stock market losses?
Yeah, look, this fourth quarter thus far has been a welcome reprieve to what we've seen. The first three quarters were extremely challenging for both equity and bond market investors. In fact, we entered bear market territory, as you noted. The S&P got as low as down 25%. Interestingly, in October, we did get quite a rebound. In fact, the Dow was up nearly 14%, S&P up 9%. The NASDAQ didn't fare as well. Keep in mind, we're going through those big cap tech earnings, which disappointed to some extent. But more broadly, what we're seeing is part of this move is driven by some optimism around a Federal Reserve that may be eventually moving at a more gradual pace. So keep in mind, tomorrow's the big Fed meeting. All eyes are on not only what they'll do in November. I think that 0.75% or 75 basis point rate hike is baked into the cake there. But more importantly, what are they thinking about December? And in fact, markets are now starting to price in a 50 basis point rate hike in December, which means the Fed may be moving at a more gradual pace, which over time, if you extrapolate that could mean they go to 25, then go to a pause. Could they eventually pivot to lower rate hikes or lowering rates generally? That is really what the market is starting to pick up on. And in fact, if we do go down that path, we do think perhaps we'll start to see a more sustainable rally ahead.
And when you say more sustainable, how much room does the market have to run from here? Certainly, a lot of people would like to see it make up all that lost ground.
Yeah, absolutely. Look, I think generally what we still have to wait for, of course, is in order to get a more sustainable rally, we'd expect or want to see a couple things. One, we do want to see inflation start to move down in a more substantial way. Now, the leading indicators are showing us that inflation is starting to roll over. We're seeing that in things like the ISM prices paid that came out just this morning, break-even inflation rates, even though supply chain pressure indices are starting to moderate, commodities, oil, all starting to at least roll over from their recent highs. So that's a good sign for inflation. The CPI prints tend to be a little bit more sticky, so we may get a lag impact there. We may still see elevated levels of inflation, but the underlying trends we're seeing are starting to moderate, which is a good sign. We do think, though, that the Fed rate hikes that we've seen already, keep in mind, we moved almost 400 basis points in the span of this year in terms of going from the zero bound to a 4% interest rate. That has a lag impact on the economy. So we do think that we're probably going to see the economy slow sometime in the first half of 2023. In our base case, we see just a mild, not deep or prolonged recession. So what does that mean for markets? Well, for markets, when you look historically, since really the 1940s, anytime you've gotten a not prolonged, not deep recession, you've seen about a 25 to 35% drawdown in the S&P. Now, we got as low as 25% already. You can perhaps argue that maybe there's some volatility ahead that would put you in that range where the downside is 5 to 10%. But the upside is what we're really focused on. And to your question, we have seen in the past when the Fed stops raising rates, on average, the market is up 16 to 25% in the year following. So we are probably in store for hopefully over time, a more sustainable rally. It may take some time. We're calling this market the U-shaped market, not the V-shaped market we saw maybe back in 2020 when the pandemic hit and the Fed could step in more quickly. It's a U-shaped recovery, but keep in mind, historically, those types of returns on the S&P are still quite favorable versus history. So really what we're seeing in the months ahead is the opportunity to position yourself for that hopefully more sustainable recovery ahead.
And Mona, we're going to go right to questions because we're getting some. There's one from Chris O, and the question talks about what do you think the high end of the Fed rate might hit, which I think you've addressed a little bit. What would CDs and Treasuries get to? And he mentions he cleared out his grandparents' house and found CDs paying 14%.
Oh, well, congratulations for your grandparents. I guess that's an amazing rate of return. Good question. I think right now we're seeing markets price in the terminal Fed rate or the terminal or end Fed funds rate at close to 5 to 5.25%. Now the good news is we're getting pretty close. After tomorrow, we'll be at 4%. If they raise rates by 50 in December and maybe another 25 to 50 in the February meeting, we'll be right there at that 5%. In our view, if we start to see some of those inflation metrics cool quickly or more quickly, we could get maybe to 4.5 to 5% range on a terminal Fed funds rate. Now, it's a great point you're bringing up on CDs and shorter duration bonds in general. We've really seen a huge concentration for fixed income investors in that shorter end of the market. CDs are very attractive in many ways in the sense that they're yielding 4%. We haven't seen those types of numbers in quite some time. But we would say what's important now is to think about your long-term portfolio. We're getting to levels where thinking about longer duration bonds, thinking about maybe some investment grade bonds that not only offer longer duration, but exposure to top corporations. Those are becoming more and more interesting as well. As we are getting close to a terminal Fed funds rate, that also means we're getting close to a peak in the 10-year yield. And that's really the time where bond investors really want to think about expanding their duration rather than sticking with the short end. Now, doesn't have to be a wholesale shift from short to long, but I think it's important to think about complementing your bond portfolio. And really, this is an attractive time for fixed income investors, more attractive than we've seen in recent history.
Yeah, it is interesting. And in fact, a lot of people are really trying to sort out what they want to do with their portfolio. We have a question from Douglas, actually, and he is, kind of looking at what to do. He's retired. What percent of his equity investments should be in, for instance, tech? Like, how does an investor now sort out where to shift things around?
Yeah, it's a great point because this past year has been a pretty rough one for tech and growth stocks in particular. As rates were rising, as the economy was potentially slowing, we've seen a concentration in returns and a concentration in investor allocations to more defensive and value parts of the market. So think healthcare, staples, utilities. A lot of people gravitated towards those sectors. But again, as we're starting to see a peak in rates and as yields come down, that's when growth starts to do well as well. And you think about the longer duration bond market. In equities, the longer duration part of the market tends to be tech growth parts of the market because a lot of their cash flows come in the out year. So when yields are moving lower, that's a good backdrop for growth. And we anticipate that in at least the next 12 months ahead, we'll start to see that backdrop fall into place. Now, keep in mind, again, it's a good idea to complement what you have in your defensive and value portfolio, but start thinking about layering in some of that tech again. We had a great performance of technology over the last 10 years since the great financial crisis through the pandemic period. Perhaps we'll have a more balanced next 10 years. But we're getting to levels where growth in tech is starting to become once again, pretty attractive. Valuations have compressed. We've seen a lot of the speculative bubbles, some of the air taken out of that, things like meme stocks, areas like the ARC type of funds, the more speculative parts of technology, all starting to see a little bit of better valuations and better, attractive parts of the market. Although we will still say that probably quality growth is what we would advocate for at this point.
Well, I want to take a little pause and go to our poll question because we do have some results and they're really kind of overwhelming in one area. We asked as an investor, what's your biggest concern heading into 2023? Lingering pandemic concerns. Zero people have that. Inflation and recession, 82.8% of our respondents, that's what they're concerned about. Interest rates, just under 3%. Global unrest at 16%. But you know what I love about this poll, and Mona, even though you point out that it might be a milder recession, this has just dominated the street, and clearly inflation still dominating. But if the Fed is moving on a campaign where those interest rate increases are decelerating, does the market need to take a big breath and think that the worst of inflation is behind it?
Yeah, that's, first of all, the audience is spot on and probably thinking about the same exact things we as investors and investment professionals are thinking about. Inflation, the economy, downturns, all front and center right now. And keep in mind, it's not only the Federal Reserve that's raising rates, we're seeing it across the globe, the European Central Bank, the Bank of England, even parts of Asian central banks, all raising rates to do the same thing, to keep inflation down and to really control the demand side of inflation, so that hopefully the supply side is starting to catch up. So as we noted, that supply pressure, the supply chain pressure, we are starting to see early signals that's starting to ease. The demand side of the equation is interesting. We're still seeing a pretty healthy labor market here in the US, and we're still seeing a pretty resilient consumer to some extent. Keep in mind, we did get a pretty strong GDP report on Thursday. Those figures are somewhat backward looking, and we do expect them to weaken in the months ahead, especially as those Fed rate hikes kind of hit the real economy. And one area that we're watching in particular is the housing market. Mortgage rates here in the US have almost doubled this year. They're over 7% on average for a 30-year mortgage. And that has really had an immediate impact on the housing market. We're seeing demand soften, prices start to cool, home builder sentiment is moderating as well. And so all things we're keeping an eye on as leading indicators of the economy. And in our view, because we started from this position of relative strength, we have a relatively healthy labor market, and US household consumer balance sheets are still in pretty good shape. That will provide some cushion to absorb some of the rate hikes that have happened and some of the rate hikes that will probably happen in the weeks ahead. And that's the good news for the US economy in particular, and gives us more comfort in our call that if we do see a downturn, it should not be deep or prolonged. Now, that being said, of course, inflation has broadened out to some extent, and we are seeing it stickier, at least in the CPI numbers. But the stickiest part of CPI, for example, is shelter and rent, and we're already seeing what's happening to housing and rent underlying those CPI figures. And so it gives us a little bit of comfort that over time that'll show up in the CPI prints as well, and some of the other metrics that the Fed follows in particular. So we're hopefully moving in that direction towards that Fed potential, more gradual pace of rate hikes, over time a potential pause, and that will give the market some stability as well.
Mona, I want you to get into the mind of the Fed a little bit. A question from John K. What do you think of further quantitative tightening? How might that affect equities in the coming year?
Yeah, it's a great point as well. And it's interesting because the Fed has used quantitative tightening as a way to kind of reduce some of the liquidity in the system, reduce the inflated balance sheet that we have seen through the pandemic period. But they've done it in a very systemic way so far. And in fact, we haven't seen major disruptions in the credit market, which to their credit, I think because they're doing it in a very gradual manner. And in fact, the Fed balance sheet has only rolled over or decreased minimally since they started the quantitative tightening program. What we do know, though, that as they are removing liquidity, taking bonds off their portfolio, bringing down their balance sheet, that does put pressure on the longer end of the yield curve. And so areas like the 10-year Treasury yield, yields have upward pressure because of this quantitative tightening program. But we do think that if they are able to continue in the manner that they have been, which is a more systematic approach, and not use it as a very abrasive tool to kind of disrupt markets in any way, which we don't think the goal is to do that. We don't think that it should have a meaningful impact longer term for bond markets. And we do think over time we'll see the supply-demand dynamic kind of be the primary driver of markets rather than the Fed impose its demand as a primary driver of bond yields in particular.
Let's dig a little deeper into equities now in terms of sectors. We've touched on a couple of sectors that look interesting. What else are you finding attractive right now? What else perhaps do you want to lighten as we look to 2023? You were just talking about housing, for instance, so that's something I'm sure you're looking at.
Yeah, it's a great question. I think generally what we alluded to earlier applies across the board still. We are hoping to get more balance in portfolios, and especially from equity sector positioning. We talked about how this year, we had been recommending value sectors for most of the year because we were in a tightening environment, because value sectors tend to do well in higher yields, and also because they're more defensive. To some extent, if you think about inflation hedges, areas like healthcare, staples, and utilities, people still need to pay their healthcare bills and pay their utilities and purchase their staples, regardless of what prices are doing. And so those sectors have worked particularly well. The energy sector, of course, has been the front runner this year, given what's happening with oil markets across the globe. But as we move forward, we think that there is opportunity to make sure that you are positioned on the other end of that spectrum. And so, in technology, we mentioned quality parts of the tech market that have established balance sheets, that have free cash flow, that, really business models that can succeed in many different environments. But if you think of some long-term themes within that, when you think about AI, robotics, cybersecurity, mobile payments, even parts of biotech and surgical robotics, areas of growth within healthcare that could be interesting. All of these have long secular themes behind them that could be interesting as we think about especially a Fed that might be raising rates for the last time in somewhat the weeks ahead. And so important to keep that balance in mind. And if you do get opportunities in the market over the next several weeks or even months that present that opportunity to position in a more balanced way, we think that will be important as we're heading into 2023.
And Mona, we're so close to Election Day, of course. Do you see any movements specifically from the stock market based on midterm elections or any potential policy issues that you kind of have your eyes on for 2023?
Yeah, it's another great question. Election Day is around the corner on November 8th. And again, when you look at history, in fact, history is on the side of stock markets. Historically, and it's been pretty consistent, on average, the 12 months after a midterm election year are positive in the market by an average of about 16%. In fact, none of the years since the 1960s have we seen a negative return in those 12 months after the midterm election period. So first note is that it's a good time for generally a good time in markets when you look at history. Now, of course, every cycle is unique, and this time midterm elections may be a period after midterms may be accompanied by that pause in the Fed and maybe inflation more notably rolling over. But I think also what's interesting is it looks like, at least what the polling and the betting odds are showing, is that we're set up for another period of gridlock after this midterm election. If the House and or the Senate shifts or turns Republican, we will then have a Democratic White House and a Republican Congress, which of course means that not much legislation, not much regulation is likely to get passed. And in fact, markets don't mind that sort of gridlock. It takes away a little bit of the uncertainty, and also companies have a better chance to plan and think about R&D and CapEx spending a little bit easier, so that without any major shifts in regulation. So we're hopeful that midterm elections from a market perspective can bring a period of relative stability in markets from not only the gridlock perspective, but hopefully the history maybe doesn't exactly repeat itself, but hopefully it rhymes this time as well.
Mona, we have a question from Ryan, who actually talks about global unrest as potentially being the main driver or cause for inflation heading into 2023. We all know the impact we've seen on the oil markets. Could you respond to that? And also, what is the biggest risk now as we look ahead to 2023, in your view?
Yeah. The geopolitical question is a great one, and it's certainly one that's hard to handicap as an investment professional. The war and the disruption from the Ukraine-Russia crisis has played out in markets in a meaningful way this year. And mainly that mechanism has been through oil, food, commodity prices. And we've seen major disruptions across the board there, and we continue to see that. The other one that we're starting to monitor more closely is, of course, any kind of geopolitical tension in China, not only between China and Taiwan, but China's policy around zero COVID, which has, of course, driven it to go into and out of lockdowns in major cities that have disrupted supply chains and major economies in their own economy as well. So, the Chinese central bank has actually been one of the few developed major central banks around the globe that is actually lowering rates instead of raising rates because they have this need to support economic growth there. So certainly we've already seen a lot of disruption from geopolitics. I think we're hopeful that any sort of major event from a geopolitical perspective is still a tail risk. Again, if you look historically, politics and geopolitics tend not to be the major drivers of markets unless there's some mechanism like commodities that we can see, being impacted more severely. And so for the most part, we're hopeful that geopolitics plays less of a role, not more of a role next year in markets. But certainly it's something we're monitoring closely as tail risks.
Well, believe it or not, time flies here when you and I chat. That is all the time we have for today. I want to thank you, Mona. Thank you, Edward Jones, for answering all of our questions.